$59.32. December 6th, 2025. Today. Silver just shattered every record in human history. But here's what caught my attention while this was happening. JPMorgan reportedly moved approximately 169 million ounces into their vaults, 9% of global supply. They've been accumulating since 2011, 14 years, quietly. Now I keep asking myself, if silver doesn't matter like so many experts claim, why would America's most powerful bank be hoarding this metal? My theory? Something significant is unfolding. And I want to walk you through a pattern I've been studying, one that's appeared in every major financial crisis in the last 500 years, a pattern that has never failed. And right now in my analysis, we might be watching it complete in real time. You still have a choice, but let me show you why this window might be closing faster than you think. I'm not a financial advisor. This isn't financial advice. This is purely educational analysis based on publicly available information. This is pattern recognition, nothing more, nothing less. Here's the thing about silver that nobody's talking about. When prices break to new all-time highs, something specific happens in the market. Either institutions panic and cap the move, or institutions are already positioned and they let it run. JPMorgan's been accumulating since 2011. Do the math. They saw this coming. 14 years ago, when silver was trading around $20, they didn't panic buy at $59. They positioned years in advance. That tells me something crucial. The big money doesn't fight the inevitable. The big money positions for it. Here's the pattern I've identified. 4 stages, always 4. And silver appears to be entering stage 3 right now. Stage 1 is what I call the setup. Authorities create what looks like stability. Prices get suppressed. The market floods with paper promises. Everything seems fine. Everyone trusts the system. For silver, this started after the Hunt brothers nearly broke the financial system in 1980. Regulators got nervous about volatility, so they built something massive, a paper market. Some analysts estimate it's around 100 times larger than the physical market. Think about that for a second. According to published COMEX data, open interest sits at approximately 244% of vaulted silver. That means if even a quarter of the paper holders demand actual delivery, the system faces serious stress. The setup was simple. Create paper derivatives so massive that the price becomes disconnected from reality. Physical becomes irrelevant. Paper price stays managed, suppressed. For decades, it worked perfectly. Stage 2 is expansion. The gap between paper promises and physical reality expands. Debt gets printed. Promises get stacked on promises, but prices stay suppressed. We've been living in stage 2 since 2008. Global central banks printed over $30 trillion. The United States alone added around $8 trillion to its balance sheet. But silver didn't explode. Why? Here's my take on this. Every time physical demand increased, major banks reportedly flooded the market with paper contracts. Short positions, derivatives. According to market data, prices stayed pinned below $30 for nearly an entire decade. Meanwhile, something interesting was happening in the real world. Solar panels need silver coating for conductivity. Electric vehicles require roughly 3 times more silver than traditional cars. 5G infrastructure exploding. AI data centers consuming unprecedented amounts of power and therefore silver. Every trend shaping the modern economy increases silver demand. Supply declined since 2016. Recycling can't keep up. Deficit of 148.9 million ounces in 2024. Projected 117.6 million in 2025. That's 8 consecutive years of deficits. Above ground stockpiles draining, vaults emptying. But paper prices stayed low because banks controlled the narrative. They controlled the paper market. The physical market didn't exist in the price discovery mechanism. Now here's where it gets interesting. And this is stage 3. The squeeze. Demand grows. People start demanding physical delivery. The vaults drain. Everyone realizes simultaneously there aren't enough ounces to cover the paper. Panic. People rush to convert paper to physical. But the physical doesn't exist. December 3rd, 2025. COMEX registered silver inventories at 43 million ounces. Compare that to October 1st, 2024. 80 million ounces. That's a 46% drain in 14 months. November 17th, alone, 613 million ounces withdrawn in a single day. That's not normal profit taking. That's a bank run. And it's accelerating. February 14th, 2025. 4 major South Korean banks simultaneously stopped selling physical silver. Not for a day, not next week. Indefinitely. These are banks with unlimited capital. Global connections. If they can't source silver, what does that tell you about actual availability? China blocked citizens from buying precious metals through banks. Raised risk classifications. Why? Because China is accumulating for the state. They're hoarding. When the world's governments start hoarding, the message is clear. They see what's coming. They're preparing. India's silver imports hit 38-year highs in 2024. Not for jewelry. The government classified precious metals alongside military assets. You don't do that for an industrial commodity. You do that for strategic reserve. Russia diverted 100% of domestic production to state reserves in 2024. Not sold, not exported, stockpiled. And what did the United States do? The country that invented modern finance? We sold our entire strategic silver reserve. Between 2005 and 2015. Every ounce. While China, Russia, India accumulated, America sold. We bet on paper markets and infinite supply. They bet on physical control. Now watch what JPMorgan's doing. Ding. Between 2011 and now, they've accumulated what some analysts estimate at 675 million ounces of physical silver. If that's accurate, that's roughly 45% of the world's above-ground supply in standard bars. More than the Hunt brothers held at their peak. More than Berkshire Hathaway ever held. More than entire nations control. Why would they do this? Here's what I think happened. In 2010, JPMorgan settled manipulation charges for around $920 million. When they acquired Bear Stearns in 2008, they inherited significant short positions on silver. For years, they were on the wrong side of the trade, so they flipped, covered their shorts, went massively long. Then they used their influence to keep paper prices suppressed while they accumulated physical. It's the perfect trade. You position early at low prices, you keep prices low, you accumulate quietly. Then you release your grip on the paper market and watch the physical market do the work. The price goes parabolic. Your position wins. Here's the crucial part that people miss. JPMorgan isn't the Hunt brothers. They won't panic sell. They won't blow up. They have institutional discipline. They have the backing of the system. They might actually be the system. So their accumulation sends a different message than the Hunt's accumulation. This isn't speculation. This is preparation. Now, October 2025, silver lease rates hit approximately 30% annualized. That's insane. People were so desperate for physical silver, they'd pay 30% interest just to borrow it. That's what a squeeze forming looks like. Backwardation screaming. Spot trading above futures. People paying premiums to get silver today over promises of silver tomorrow. That's not normal. That's panic. November 28th, 2025. The CME exchange went down. Official reason? A cooling failure. A cooling failure in a market with military-grade infrastructure that handles trillions in trades. Veterans know what this means. When exchanges halt mid-spike, someone big is in trouble. During that outage, silver spiked to approximately $56.72 per ounce, all-time record at that moment. When systems came back online, bid-ask spreads were over $1. That's chaos. That's what happens when a paper market faces stress. That's what illiquidity looks like. And then, days later, something caught my attention. JPMorgan reclassified approximately 13.4 million ounces from registered to eligible status. Registered silver is available for delivery against futures contracts. Eligible silver is just stored there. Not available. Think about the timing. JPMorgan pulled roughly 9% of deliverable silver off the table during peak physical demand. That tells me something. They're preparing for stage 4. They're securing their position. They're tightening the noose. December 6th, 2025. Silver hits $59.30. That's approximately a 98% gain year to date. The strongest annual performance since 1980. Analysts are scrambling to update targets. Bank of America called for $65. Citibank called for $62. Those targets are being exceeded. Now what happens if we break through 60 and consolidate there? What happens if the Fed cuts rates as expected and the dollar weakens further? Historically, silver follows gold. It always has. Gold is at $4,200. Some analysts project $4,500 to $5,000 by mid-2026. Silver tends to move faster, more volatile, more explosive. When this runs, it doesn't rise gradually, it erupts. Here's where history becomes crucial. The Hunt brothers. 1979, two billionaire brothers looked at silver trading around $6 and saw something others missed. Inflation, consumption exceeding production, a perfect storm. They bought approximately 200 million ounces, 1/3 of America's entire supply at the time. Then January 1980 arrived. According to historical records, silver hit $49.45. That's roughly 724% in 18 months. Banks panicked. COMEX changed the rules overnight, banned new long positions, forced liquidation. Only Silver Thursday came next, March 27th, 1980. The Hunts were destroyed. But here's what matters most. The people holding physical silver, not futures, not paper, just metal in their possession, they didn't lose anything. When dust settled, silver was $10. That's still 66% higher than where it started. The people who bought physical at $6 and held through chaos made enormous returns. The Hunt brothers failed because they used leverage and paper. The system changed the rules. You can't change the rules on something you actually own. Now imagine something with me. What if the buyers weren't two reckless billionaires? What if it was the bank that helps make the rules? What if JPMorgan's got physical while the paper shorts struggle? That might be what's happening right now, and that changes everything. Because when JPMorgan's position wins, they don't need to do anything. The math does it, the deficit does it, the supply squeeze does it, the price goes up on its own momentum. Stage 4 is what I call eruption. Price explodes, shorts get crushed, institutions positioned early win big, everyone else scrambles. This is where I believe we are approaching right now. The signals are everywhere. Record highs, structural deficits, bank accumulation, paper market stress, Fed meetings, geopolitical tensions, all happening at once. That's not coincidence, that's convergence. Here's what keeps me up at night. COMEX registered silver is at 43 million ounces. That equals less than 3 weeks of global consumption. 3 weeks. When registered inventory drops below 30 million ounces, historically the system faces serious stress. Current drain rate, 6 to 12 months. Maybe sooner if there's a rush. What happens when holders of paper silver contracts demand physical delivery? What happens when they realize there might not be enough metal to cover all the claims? What happens when pension funds, sovereign wealth funds, retail investors all try to get physical silver simultaneously? That's stage 4. That's eruption. Here's what I think people miss. This isn't coming tomorrow, but it's probably not 10 years away either. The Fed meets December 9th. That's tomorrow. Current probability of a rate cut sits at 87.2%. If they cut, the dollar weakens. When the dollar weakens, historically gold and silver surge. Silver tends to move faster, more explosive. The dominoes are positioned. The Fed meeting could be the first one to fall. Let me tell you about the 1980 lesson. Prices went parabolic, but physical dealers couldn't keep up. Premiums exploded. People with cash couldn't convert it to actual metal. When the paper market breaks, when futures contracts face delivery stress, premiums don't rise gradually. They jump. Spot at $60, physical dealers charging $80, $90, $100 just to get metal. Then one day, paper market freezes entirely. Contracts suspended, lawsuits filed, and people holding physical silver watch from safety because they already won. This isn't speculation. This is pattern recognition. And the pattern is screaming. Here's what to understand. Owning versus speculating. Trading paper silver for quick profits, that's speculation. Buying silver as protection, as store of value, as insurance against monetary collapse. Only one option. Physical metal in your possession. Not in a vault you don't control, not in an ETF, not in futures. In your hand, in your safe, where you can see it, touch it, secure it. That's ownership. Second, buy now while premiums are reasonable. Physical silver available today at $3 to $5 over spot. When squeeze accelerates, premiums will be $20, $30, $50 over spot. Eventually, none available at any premium. Dealers sold out. Mints with year-long wait lists. The window is closing. Not because some guru says so, not because of hype. Because vaults are empty, banks are stepping back. Backwardation is screaming supply is gone. The market is telling you the truth. You just have to listen. This is the largest financial story of 2025. The silver situation isn't coming. It's already here. The only question is whether you're positioned to understand what's unfolding or whether you'll look back in 6 months wishing you'd paid attention. If this made sense, if you see the pattern, subscribe now. Because what I've shown you is just the beginning. The silver price surge is one symptom of a much larger systemic failure. In the next video, I'll show you exactly what's happening behind the scenes. The currency crisis, the debt spiral, the institutional positioning, all converging on something inevitable. Subscribe, watch the next video, learn how to position yourself. Because people who see the pattern early don't just survive, they thrive. The clock is ticking, the vault doors are closing, and the $100 window won't stay open forever.